Welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In this video, I'm going to compare a Roth IRA versus a 401k and decide which one is better for you in your situation. So I'm going to completely break down a Roth IRA, talk about any contribution limits, age limits, things like that. And I'm going to do the same with a 401k. We're going to compare both of those and come up with a plan of action based on your situation. So what are these things even? What is a Roth IRA? What is a 401k? So if you're not familiar with these two terms, these are essentially, and again, I live in the United States, so it applies country by country, of course. A Roth IRA is essentially a self-directed retirement account, and a 401k is an employee-sponsored retirement account. So in short, these are both two ways that you can invest for your retirement. So with all that being said, let's break down the Roth IRA right now. So the first nuance of the Roth IRA is that we're investing using after-tax dollars. Okay? So after-tax dollars are pretty self-explanatory. This is just basically whatever your net income is. So say, for example, you make $100,000 a year. Obviously, you're not realizing that on your paycheck because taxes have to be taken out, whether they're state, local, federal, etc., etc. So after-tax dollars are used to invest in a Roth IRA. So let me back up just half a step here. A Roth IRA, again, is just a vehicle to help your money grow tax-free so you can access it during retirement, okay? So you can invest in whatever you want in your Roth IRA. It could be stocks, bonds, mutual funds, pretty much any security that you can think of. And if you own a self-directed Roth IRA, you can actually invest in real estate, companies, LLCs. There's a plethora of different investments you can use with a Roth IRA. However, that's outside the scope of this video. I'm just going to talk about a traditional Roth IRA where we're investing in securities. So let's say we're using this to buy an index fund that tracks the S&P 500. And we've contributed, let's call it $30,000 over the course of like 5 or 6 years, okay? So this money actually grows, or it could go down depending on the market conditions, but historically it's always gone up. Let's just use $45,000 as an example of this money growing tax-free. This $30,000 is what you contributed. So whatever you end up growing this nest egg to, that's it. That's your money in retirement. There is no ordinary income tax taken off on that amount because it's already been taxed. So that's one of the beauties of the Roth IRA. So say you grow this thing to $1 million, $2 million, it just depends on whatever you invest in and how long you've been investing for. This is an excellent tool to preserve that wealth because of two reasons. You don't know in the future what tax bracket you're going to be in. So if you're a high income earner and you start taking out these distributions, if this was a 401k, which what we're going to talk about later, you have to pay ordinary income tax on that. With a Roth IRA, that money is yours, period. The second part to this is that tax rates can change. So let's just say worst case scenario, this country's tax rates go to something crazy, like 70, 80%, right? Let's call it, I don't want to say socialism because I know that's a naughty word, but ultimately let's just say we get to 80, 90% tax brackets, okay? This is hedging against that. So it doesn't matter what the tax brackets are in the future because this is after-tax money already. And again, whatever it grows to is yours. Make sense? Okay, so there is a second nuance to the Roth IRA, and that is that you have access to your contributions. I'll just call it 24/7 at any time. Okay, so what this means is that, again, since this is after-tax dollars, I can take out that original, let's just use 30 grand for example. I can take out my original contributions penalty-free, tax-free, and worry-free because I've already paid the taxes on that money. So when you invest in that 30 grand in an index fund, for example, and let's just say it does grow to that 45,000 or whatever it ends up growing to, at any time, without any age limit, I can take out this $30,000 if I wanted to. What I can't take out, however, is whatever the amount has grown to. So if we stick with that example of $45,000, I can take out this 30, but I can't touch the 15. Does that make sense? So again, you can take out your contributions, you can't take out your gains. So another thing about the Roth IRA is that there is no, let's call it, required minimum distributions. So if you invest in a traditional IRA, which is a traditional retirement account, at age 70 and a half, you have to start taking out minimum distributions. So let's just say you have $1 million in your traditional Roth IRA, your traditional IRA and not your Roth IRA. The government dictates, or the IRS dictates, that you have to start taking out minimum distributions. So the nice thing about the Roth IRA is that you don't have to touch this $1 million right here. And this actually comes in handy for estate planning. And then you can actually leave it to your heirs, or you can actually leave it to, charity, philanthropy, whatever. Or you can just cash out and ball out and go to Vegas and do whatever you want. You can put it all on black and let it ride. However, the nice thing about this is that if you do have money left over in your Roth IRA and you do end up passing away, you can leave it to your heirs tax-free, which is really cool. Okay, hopefully this is all making sense so far for everyone. Number 4, this is not necessarily a nuance, this is just the eligibility and the rules that I want to go over, because there's obviously caveats to being able to invest in a Roth IRA. So the max contribution for 2019 is $6,000 if you're under 50, and I believe it's $7,000 if you're over 50, okay? So if you go back to using that example of that index fund, you can't just invest $30,000 in 1 year or $1 million in 1 year. You can only contribute $6,000 per calendar year, okay? And then if you're over 50, the government gives you a chance to catch up a little bit by giving you another extra $1,000 that you're able to contribute, okay? So you can start withdrawing this. So let's just call this age. You can start withdrawing from your 401k, again, the contributions, not just, the gains, not just the contributions, at age 59 and a half. So let me repeat that. Sorry, I kind of flubbed that. At 59 and a half, whatever's in the Roth IRA, you can take out without worrying about taxes or penalties or anything like that. So whatever's in there at 59 and a half is yours. And again, the contributions, what you contributed, you can take out at any time. So if you do decide to take it out before 59 and a half, so let's just use that $45,000 example. If I wanted to touch that principal, so remember this grew from 30K to 45,000, let's say I wanted to take out the full 45,000, I would pay 10% on the gains. So I'd pay 10% on 15,000. I'd have to pay $1,500 as a penalty. Makes sense? So we're not going to do that though. So age 59 and a half is the magic number. So there are income limits to this. So if you're reporting single, or let's call it head of household, if you make more than $122,000 in a year, you can't contribute to a Roth IRA. There's a little, how do I say this? There's a band where you can contribute smaller amounts, and there's a whole schedule online if you're really interested. But essentially, if you make over $122,000 a year, you cannot contribute to a Roth IRA. If you're filing jointly or married, and this is what I file as, I'm with my wife, you can't make more combined than $193,000 in a year. And again, they start minimizing at 193, and then there's a complete cutoff point, which is a little bit higher than this number, but please go online to verify that. So ultimately, the last caveat with a Roth IRA, and this is the catch here, you can only contribute what you earn in a given year. So if you're working at McDonald's and you make $3,000 for the year, let's just say you're, 21 years old, it's a part-time job, whatever, you make $3,000 in a year, you can only contribute $3,000 in the Roth IRA. So that's kind of how the government caps you there. So I hope this was helpful. Let's dive into the 401k. Okay, so let's talk about the 401k. So unlike the Roth IRA where you're contributing with after-tax dollars, the 401k is you're actually contributing to your retirement plan with pre-tax dollars, okay? So these pre-tax dollars are actually tax deductible. So we'll call this contributions tax deductible, okay? So let's just say Sue makes $100,000 and this is her W-2 income. She's going to realize ordinary tax on $100,000. If she decides to contribute, let's just use an arbitrary number, and I'm actually using this number for a specific reason. You'll see in the next reason. Let's just say she puts away $6,000 in her 401k. Her gross income is actually going to go down to $94,000, so she ultimately pays less taxes for that year. Does that make sense? So again, she makes 100 grand, she contributed 6 to her 401k, so her taxable income or ordinary income is $94,000, okay? So that's one of the benefits of a 401k is that your contributions are tax deductible. However, the second one, and this is actually the most powerful portion of a 401k, is that you have an employer match, okay? So this is exactly what it sounds like. So you're gonna beat Warren Buffett in the market, you're gonna beat Charlie Munger in the market, you're gonna beat everyone using this because this is literally free money, okay? So we'll call this free money. What an employer match is that your employer allows you to contribute, or they can match anywhere from 0 to 6% of your salary, and they can match, let's call it 0 to 100% of that contribution or of that match. So to simplify this using numbers, let's use Sue's salary of $100,000, and let's say her company matches 6% of her salary, and they match 50% of that 6%, okay? So for every dollar that she puts in up to 6% of her salary, which is 6 grand, which is the example we just used, she gets 50 cents out of every dollar from her employer for free. Free money, literally free money. There's no other way to explain it. So let's put some math behind this. If she's gonna contribute, let's just call it up to her employer match, that's 6%, she's putting away 6 grand, her company is going to give her, she's going to contribute 6 of her own money, and her company is going to give her 50% of the 6 of literally free money. So it's like she put in $9,000 when she only put in 6 of pre-tax dollars. So not only is she getting the benefit of that tax deduction, she's also getting free money from her employer because a 401k is an employer-sponsored plan. Make sense? So free money, employer match, that's the winning ticket right there. So the nice thing is that this also grows tax deferred, but it's also a double-edged sword because this is tax deferred. It's not tax-free like the Roth IRA. So what happens is if we use the Roth IRA example, let's just say we end up with $1 million after 30 years of investing in this 401k. Whatever tax bracket you're at the end of this 30 years or whenever you decide to retire or start taking withdrawals from your 401k, it's going to be taxed at ordinary income. So whatever your income level is at, let's just say you're at a 28% tax bracket, it's like you're getting paid from your W-2 income. That $1 million is going to get taxed every time you take out distributions, okay? So higher tax bracket equals higher taxes, which kind of sucks because who knows, again, what the taxes are going to be, 20, 30, 40 years from now. So let's go over some quick eligibility and rules of a 401k. So your max contribution is much higher than a Roth IRA. It's actually, for 2019, it's $19,000. So your employer may only match up to 1, 2, 3, 4, 5, 6%, but your max contribution above and beyond your employer match is actually $19,000. And whatever your employer matches does not count towards this $19,000. Makes sense? So in Sue's example, she can actually end up putting away 22 grand in 1 year because her employer is matching 3 on top of the 19 that she could possibly put in. Makes sense? There's also a catch-up. So if you're over 50, you can add an additional $6,000 on top of that 19, if that makes sense. So you're wondering, when can I take my money out? So the withdrawal age is just like the Roth IRA, 59 and a half, if you can read my chicken scratch writing. And then there's also not necessarily a contribution limit that disqualifies you like the Roth IRA, but there is an annual amount that you can actually base your salary off of for the match. So let's say, for example, instead of Sue making 100 grand, let's say she makes 400 grand, okay? So for 2019, the annual compensation limit is actually $280,000. That's the max that your company can match based on your salary. So if you remember that 6% that Sue was getting, or the 50% of the 60%, or excuse me, of the 6%, she can't go higher than 280, okay? So if you multiply, how do I do this easily? Let's just say 50% times, sorry, you can't read this because my handwriting's horrible, and I'm just doing this on the fly. 6% of that 280. That's what her employer can match up to. So you take the 6% of the 280 because she makes 400 grand, okay, and you can't go above that, or you can't go above 280, excuse me. You take the 6% and then half of that is basically her employer match, if that makes sense. So there's finally one more caveat to a 401k, and that is that you can take out loans against your 401k. And I'm not even going to get into 401k loans in this video because I don't recommend them. You have to pay interest. It's basically stealing from your future self, if that makes sense. So I know that this was a little bit more complicated. It's really simple. The 401k, it's before tax dollars, and ultimately, you have a higher limit for contributions, and then you also have to pay ordinary income tax after that age of 59 and a half. Okay, so thank you for sticking with me this long. I know it's been long and brutal, but it's super important. So I promised in the beginning of the video that I'd show you a game plan, so to speak. So let's get right into that game plan. This boils down to two scenarios. Whether your employer offers a match, okay, or let's just call it no match. Scenario one, scenario two. When I say match, that's obviously talking about the 401k that we just learned about. So if your employer offers a match, what you want to do is at least contribute enough to earn that match. So in Sue's example, where she's making 100 grand, the employer matches 6% of her salary. You want to be able to contribute at least the minimum of to what your employer is going to match. So in her case, it's going to be 6 grand. When she does that, she should then max out her Roth IRA, which in 2019 is 6 grand. And then if she wants to invest any more, she then goes back to her 401k and then invests as much as she can up to that $19,000 mark for 2019. Now, if your employer doesn't do any match, let's think about this logically. You want to max out your Roth IRA first with that 6 grand for 2019, and then you can contribute as much as you want into your 401k. The reason for that is pretty self-explanatory. The Roth IRA is going to grow tax-free, and then all the benefits and advantages that we mentioned in the video. So that's it, you guys. That's the game plan. I hope you got value out of this video, and if you stuck around to the end, you are the real MVP. I know it was long. I know some parts were dry. I wasn't usually as funny, at least I don't think I was, as my normal self, but I do appreciate you sticking around. As always, if you got value out of this video, I would appreciate it if you hit the like button and shared the video with one friend. If you haven't subscribed already, please do so, because there's a lot of free information on this channel. Thank you so much and have a prosperous day.